Hello and welcome to NDTV Profit. The market regulator came out with a consultation paper which basically brings in restrictions for offshore derivative instruments or also called as participatory notes. It also equates the kind of compliance and regulations which are available, which are existing for foreign portfolio investors in India to those being held through FPI route or ODIs held through FPI route. And to discuss this consultation paper, I have with me Moin Ladha, who is the partner at Ghetan and Company. Moin, what is the first impression from the consultation paper that you get?
I think the first impression is that the regulator is very keen to take as many measures as possible to get to the back end of beneficial owners, discourage derivatives generally, and P-notes or offshore derivative instruments, as we call it, have always been the bad boys and have always been under the radar since almost a decade now. So this is yet another measure which makes it more difficult to be issued, as well as, it makes it more unattractive. So I think these are my initial impressions, honestly, on the discussion paper. Obviously, it's still a discussion paper and there will be a finalized regulation based on the feedback. But this is really what I think about it.
If you look at some of the key regulations or the key proposals which are coming through in this discussion paper, the one being which came in August 2023, which is concentration and size. Now that was something which was imposed on the foreign portfolio investors who are registered in India, and many of them were given 6 months to a year to comply with them or redeem their investments from the country. Now the same has been put on the ODIs as well. How do you see this playing out for them?
I mean, see, none of us will say that ODI had any relaxed beneficial ownership disclosure requirements. This started off as a route to avoid regulatory complexities and yet access the Indian markets. But over a period of time, it was looked at as a route which was misused on certain occasions where beneficial owners were not disclosed. So SEBI has consistently required additional details, regular interval details of beneficial owners. This amendment now, I think it has a twofold impact. One is that one will have to see how at a subscriber level the implementation will be done, because there is a, the FPI related amendment had a twofold, requirement. One was driven by how much market exposure you have in the Indian market. And the second was if your single stock exposure was 50% or more. Now with and while there is a solution proposed in the discussion paper, one will have to see how in a segregated or a sub-fund level system where the fund has multiple funds, how this compliance will be undertaken, and whether if one cannot undertake this compliance, then essentially it becomes ineligible. They need to liquidate, they need to give up. So whether it really means that one will be able to do such subscriptions is also going to be one question.
The interesting fact is that the sub-fund level or the segregated level was not even applicable in FPIs for FPIs today. Now it will be applicable for FPIs and ODIs. So from we are taking off from what we did in August of 2023 and going back or going forward to another level of micro level where you can do it. And I think one of the biggest concerns with many of the FPIs or market intermediaries had was that it's very difficult for them to monitor these things at that level. How do you manage such a kind of concern for the FPIs then?
Well, I think on the aspect of segregated funds, there was a regulatory arbitrage so far as these ODIs is concerned. My personal thinking is that even if you managed it through sub-fund segregated funds, as an FPI, the disclosure you were required to make if you had a single entity exposure of 50% or single stock exposure of 50% or more. And I think you're right. Managing compliance is always going to be a challenge. But I think the thresholds are large enough At an FPI level, I don't think this should be very difficult to do. At an ODI subscriber level, given the fact that the ODI subscriber is using this route, assuming it's a genuine investor, to reduce complexities, are we really reducing complexities is the question, and whether the number of additional uh, intervals and daily reportings that will be required, whether FPIs will be keen to further continue or use this route is the second question. And the third, I think, amendment is that you have to have a separate FPI registration only for these purposes. Maybe this will bring some ease on monitoring compliance, because commingling and using the same FPI for your proprietary investment and as well as managing ODI underlying investments has always been a greater challenge.
That's true, and we saw that happening in some of the stocks last year as well, where funds came in and shorted some of the companies there. But specifically on the issue of separate registration for ODI FPIs, is it going to increase the compliance cost, and does it make it now more suitable to come directly to the Indian market?
I think that's the intention of the regulator, that if you want to get the benefits and advantages of the Indian market, you better come directly. You register, but you see there is a broad basing requirement. There is an annual compliance requirement. There are various conditions. So it depends on how committed the investor is to our market. I don't think it still becomes as complex as registering as an FPI. And on your question of separate registration, that is for the issuer. The issuer needs to do that. And it's only a question of how attractive this model as a business will be for issuers. And eventually, when we have the final amendments in place after the comments on discussion paper are considered, will we know whether this really remains as a model, or is this an indirect way of saying that we reduce it even below 2.1% or to a very, very minuscule percentage.
Is there a route available, Moin, and I don't know whether you will be able to answer that, of a liberal regime if you're coming through a gift city?
No, coming through a gift city, I don't think the SEBI has given any exemption if you're following and press P note. I may be wrong, but I don't think there is a liberalization or reduced disclosure requirement if you're coming through gift city. That's more to do with accessing overseas market, in my view.
Okay. Another thing which was the biggest issue, and though there is not much of an exposure there, is the benefit which was given to ODI with respect to hedging of positions, right? If you have a position in India, you can hedge them on a one-on-one basis into the derivative markets in India. Now, SEBI has withdrawn that exemption provided to ODIs. Will that be a big deterrent? Even though if you look at with what the data has been provided by the regulator, none of the ODIs have an underlying derivative exposure except for the issuer, which has some 3,000 odd crores of exposure.
I think, I'll try my best to answer this question. There may be financial mechanics to this as well, and as a solicitor, I will have limited, understanding on that. But the thinking was, and what I could understand is that there is multiple levels of leveraging, and there are multiple levels of, derivatives involved in certain situations. So ODI per se is like an offshore derivative instrument which has an underlying stock. Correct? And you're using an ODI further down to leverage with a derivative instrument is another issue. So I think those multiple levels is what is trying to be addressed. And yes, it was allowed on one-on-one basis. To my mind, it will still be allowed on one-on-one basis, but in the cash segment, really.
So basically, you create a a synthetic structure at the ODI level and then come and hedge in the cash market. That's what it means, right?
Yeah, and as you know, and you must have, as you've seen over the last few weeks, we are getting more and more sensitive on how our derivatives market and the derivative securities market is being controlled or handled. and someone taking positions in the Indian derivative market only with the intent to hedge really creates a sort of a risk for the investors. That could be one of the thinkings that SEBI would have had with this proposal.
Over a period of time, we have seen a shrinkage of the entire, P note area from 44% to now 2.5%. But in terms of value, is still much higher. I mean, 1.4 lakh crores coming through the ODI route, which is there, and that compares to 2.4 lakhs, at 2007 level, which is there. But the concentration of AUM in the hands of few. Because number of FPIs have also moved from those jurisdictions to directly into the Indian market. Is that something worrying SEBI?
It could be one of the concerns. It could be one of the concerns that is worrying SEBI. But I think the real intent seems to be that whoever it may be, it should be a genuine investor. And it should be someone who is not misusing the route to make an investment to get around any limits that are prescribed under the takeover regulations, say, or limits for non-public shareholding. So that could also be a few other concerns SEBI would have thought of, while proposing this discussion paper.
Do you see some kind of resistance coming against this consultation paper?
I see. I mean, it can really depend on what is going to be the impact on an FPI to be able to leverage its position in the Indian market. If that really happens, there may be some resistance. And as you know, this is still not law. So we do have the opportunity to put, comments and provide data to substantiate if there should be another measure or a more easier way to leverage if cash one-on-one basis, security to security, cash to cash, hedging is not possible. Apart from that, I don't know what kind of resistance one can make so far as disclosure requirements are concerned, separate registration requirements are concerned, because this is the discretion of the regulator generally.
Is it fair to say that at the end of it, it's basically the issuer, which is the issuer of ODIs, and the DDPs, dedicated depository participants, their role and their compliance levels and the complicities of their life is going to increase if this discussion paper goes through?
That is correct, and they've been used to complexities increasing at regular intervals, so I think it should be manageable for them, but on a lighter note, really. That's really a good summary. I agree with you.
Moin, thanks for joining us today and giving us your perspective on this consultation paper. Thanks for joining on NDTV Profit.
Thank you very much. Thank you very much. Thank you.